Closing factory overhead. We have to close the overhead account because it is just a temporary account. Remember that when we estimate overhead, we have the predetermined overhead rate. We multiply that by whatever the activity base is, like machine hours, and we get the amount, the estimated amount of applied overhead. When we do that, we credit factory overhead. Then later in the period, when we have the actual costs and we go to record actual costs, the journal entry is a debit to factory overhead for the actual costs. Now, hopefully, the debits and credits will end up being sort of close because we want the estimation to be fairly close to accurate anyway. But if that's the case, then the balances will almost cancel each other out. And that's what we want because at the end of this, we want factory overhead to have a zero balance. Because again, it's just a temporary account. So depending on whether actual overhead is greater or less than applied overhead, the factory overhead account will either have a debit or credit ending balance. If the applied overhead is less than the actual overhead, then the factory overhead will have a debit balance, and that will be called under-applied factory overhead. If the applied overhead is more than the actual overhead incurred, the factory overhead account will have a credit balance called over-applied factory overhead. So over here, if there's a credit balance, this would be over-applied, meaning that the costs were overestimated. If there's an ending debit balance, it will be under-applied because not enough costs were estimated. This is a representation similar to what I just drew out in the T account in the previous slide. So the top image is showing the factory overhead T account, very similar to what I just did. The company applies overhead. Remember, applying, that's crediting factory overhead, using a predetermined rate estimated at the beginning of the year. Then during the year, the company records actual overhead costs with debits to the factory overhead account. At period end, we determine whether the applied overhead is more or less than the actual. So this slide is very important to help you understand that a little bit better because it's very confusing. But if you just think about the T account for factory overhead, remember that you debit factory overhead for actual costs, credit factory overhead for those applied or estimated costs. Then if there is a debit ending balance, that means that overhead was underapplied or underestimated. Or if there's an ending credit balance, that means that overhead was overapplied or overestimated. So whichever, whether it's a debit or credit balance, to zero out the account, you have to do an entry for the opposite of that. And for these purposes, we are going to close factory overhead to the cost of goods sold account. So you can see the journal entry is going to be one way or the other. So here's an example to hopefully help you understand that a little bit better. And you might have to rewatch this part of the video, the lecture, to help it to sink in just a little bit. But here's how you would do this. So a manufacturing company applied, anytime you see applied, that means estimated. So a manufacturing company applied or estimated $300,000 of overhead to its jobs during the period. So that's going to be a credit to factory overhead. Prepare the journal entry to close over or under applied overhead to cost of goods sold for each of the following separate cases. So the first example would be that $300,000 of overhead were estimated or applied. So this information here, I have already laid out in this T account. So when you apply overhead, that is a credit to overhead. Actual costs will be debits. So these will be debits to overhead. So 1, actual overhead costs equal $305,000. So that would be a debit of $305,000. So what that means is that there will be a $5,000 debit balance in the factory overhead account. So this is where the actual costs are calculated in the debit column. What that means is that the actual overhead costs were greater than the applied or estimated costs. So to zero out this balance, we need a credit of $5,000 to knock this down to zero, a zero balance. That means we need to credit the factory overhead account $5,000. The other account that we use in this journal entry is cost of goods sold. So we would debit cost of goods sold since we have to credit the overhead. So debit cost of goods sold and credit factory overhead for the $5,000 to zero out that account. So that is an example of when actual is greater than applied. So then looking at this second scenario, we already have recorded our applied overhead of $300,000. So now the actual overhead costs equal $298,500. What that will give is an ending credit balance of $1,500. So to zero that out, we would need to debit factory overhead by $1,500. So here the debit will be to factory overhead, and the credit would be to cost of goods sold. And that's how you close factory overhead to cost of goods sold.